Hey guys, this is a market update. We're definitely at an inflection point now after the election. All of that hype, speculation, money flow in, that's all over. And now we're just waiting for that next thing. And it's not really arrived yet. And so I suspect we just consolidate further. But we've not broken down from this very bullish wedge pattern here. I'll show you that in this video and a lot of macro data because things are changing. This year should be a very, very good year for Bitcoin price action if you look at the cycle. Well, inflation coming down, that means central banks can be a bit more dovish. Pretty good for Bitcoin usually. But the big thing that's changing is, real policy. Cutting of government workers, cutting of government spending. It's a drop in the ocean right now, but this is going to affect the price of risk assets and the markets massively if they keep on going. So I want to talk about it in this video. As for the Bitcoin price, look, as I said, we have not broken down from this wedge. It's a consolidation. It's a very bullish pattern in an uptrend, to be honest. You can see these kind of falling wedges here, but we try and break out of them. Look, I think we just go sideways and down. And that's what Bitcoin does for 80% of the time. Sideways down and then re-rates once it gets a bit of attention again. And so I just think we're one of those. But I'm pretty positive for the rest of this year. This should be a good bull market year for BTC, but it doesn't happen when you want it to happen, right? It always surprises people, the timing. There's a lot of macro stuff and, US and Russia stuff happening now. And why would people pour into markets whilst that is being talked about? Maybe people pull back until something gets worked out there. So pretty bullish, but look, patience. And, when the Bitcoin price is weakened anyway, I want to be definitely getting involved. If you do trade crypto, check out Bybit. Up to $30,000 deposit bonus if you click the link below in the description. And Apex, which is Bybit's DEX, if you can't trade on it on Bybit, you can get a 10% fee discount now by the link below in the description. I'll come to some inflation figures, which I think are the really important thing right now. And some of this data coming out of the next few months could potentially set us into the next wave. If the inflation figures still actually start to climb again, not good news. But if we're looking at the forward data, it does seem pretty soft overall. So that's decent. If you look at the three major blocks, you've got China with basically no inflation. They want to stimulate, but they can't stimulate too much because they'd smash their currency versus the dollar, and the Fed's pretty hawkish still, right? Then you've got Europe, which is a total mess. The ECB made a post on X the other day. How about their 2% inflation target is being met? That's coming way down, right? They are the responsible factor in inflation and GDP being positive because there's no growth in that whole economy in Europe, right? So that's going to keep coming down. They're going to have to stimulate. Look at the exchange rate, euro-dollar exchange rate. It's like this, right? Straight down. It's almost at parity now. It's a complete disgrace. So they're going to have to stimulate, right? They're not going to get out of their malaise anytime soon. Then you've got the States where the Fed is still pretty hawkish. The bond market's still basically not pricing in any rate cuts. One rate cut this year, that could really, really change. And if that comes down and changes, it gives everyone else cover to stimulate as well, because they all need to, right? The fiat currency system needs to create more currency units continually. If you're a long-term investor, just take a step back. The currency is going to get completely debased. Strong money is Bitcoin. It's going to outperform, obviously. But in the short term, that's what we're looking at, this next inflection as well. So this is CPI core services less shelter, and then job openings, which is a leading indicator here, potentially showing some softness, which is pretty good news for risk assets. We don't want it to carry on though, right? Because then you start to get the market worrying about, are we going to come into a recession? So if you look at PCE, which is actually what the Fed looks at for its inflation targets, around, it's actually just taking a little leg higher now. But I've seen some bank forecasts which show that it could be coming a little bit soft in the next reading as well, which would ease the market a little bit, hopefully. I think things are pretty decent from the inflation front. If we start to leg up again higher with inflation in the States, not good, because then they have to get more hawkish and other central banks can't stimulate in the way that they would want. And if you want prices to go up for BTC, you have to be looking at stimulus, right? Because we're valuing this in fiat currency. So how does the price go up? The base of fiat currency. That's what we're looking for if you're trading short term. But look, big picture, if you don't trade short term, it has to debase itself because this currency is a debt-based currency. Debt debases itself. You have to create more and more and more debt to pay off previous debt. You have to inflate prices to make the debt cheaper. And if prices don't inflate higher and go down, it means the debt becomes unpayable. So that is the reason I'm in Bitcoin. But obviously for short term, we just want this to come in a little bit soft so that the central banks, especially the US central bank, can ease a little bit. That would push asset prices higher. I think for the most part, I would say I lean on the side of it coming in a little bit soft, which is good news. The worry that we should all have, and I've made some previous videos about this, is we just don't know the extent to which the government is going to cut itself and cut spending and make people redundant, and how that's going to affect the economy. Because that's definitely a drag on GDP and inflation, which is good because we need that because inflation was way too high. But you're also dragging GDP, which means that the price level doesn't rise, but everyone still has the same amount of debt. This is a potential issue. So this is since the inauguration, fiscal deficit, potentially the first signs of climbing out of that. The problem here is that the government is the reason why GDP and inflation are positive. It's necessary for that to happen, otherwise all the debt becomes insolvent. But if you cut this is government spending in red and tax revenue in blue here. This delta is the issue, right? But the problem is that this delta is the reason why GDP and inflation are positive, which you will require in a debt-based system. If they start to cut this down, you're going to start cancelling money out of the system because you're cancelling money. So what the government does is spend money first through debt creation and spending, and then cancels it out through tax. And so if you're cutting spending, you are dragging GDP and inflation, which is what everyone would call a recession. Right? Market's going to get completely hysterical and scared about this, drop, right? That's the issue. They're going to have to cut tax as well. I know Trump wants to do this. Do you think that these people are going to perfectly time the tax cuts and the spending cuts and everything else to just perfectly disinflate the government whilst also creating investment and deregulation that perfectly coincides with that cut, and this comes up and meets that spending? I don't think it's going to be perfect, and so there's going to be a rocky road. I think things are very different now. It's not just money printing anymore. These things are harder to predict because they're real life, they're real people. They're actually being made redundant now, and that's going to have domino effects. IRS to lay off 15,000 hires. This is home prices in Washington D.C. fell by $140,000. Right, this is again, you can see here Doge layoffs begin. This is unemployment filings. This is going to have a domino effect around. They spend less money, their families can spend less money. The knock-on effect of other people in the economy there. So this is going to hit, right? Now, it's tiny, right? 2% of the 2 trillion goal. But if they're cutting 2 trillion out of government spending, you have to find that in the private sector. So maybe they can. And so maybe we're just entering an era of amazing, private markets actually generating wealth again. That would be great. However, if the private market genuinely creates wealth is the abundance of goods and services, which means those things get cheaper for us. Us being wealthy means we can afford more things, and those things that we buy get cheaper. That's a drag on GDP because the price level falling drags GDP, and you have the debt-based financial system that requires positive inflation. There is no other way out other than continually printing currency units. So long term, that's why I'm in BTC and hold spot, because you don't want to get caught out by using leverage on most of your investments, and the volatility is going to wipe you out. Hold most in spot, take some short-term trades for sure, but look, I don't know how this is going to play out, but this is the important thing. Also, just to prove how insanely important the dollar is, like I showed you with the inflation figures, it is the US that is the linchpin here. Europe and China, they want to stimulate, but it's the US that's holding everything back because their inflation is still too high. But if the government is cutting, that could bring things down. That could actually give cover for way more stimulus from a weaker dollar, potentially more stimulus there. That would be good for the other central banks to start easing more aggressively as well. You can see this is from Jamie Coots here. This is a global money supply in USD. You can see that most countries, again, the money supply has to come into positivity, right, all the time. They have to print more and more and more currency units. But it's the strong dollar. They can't really go too strong and too aggressive. It's the dollar coming down that's going to really affect things. And so they don't really want a weak dollar right now because they're still negotiating lots of stuff. Get that out of the way. Maybe they can come to some accord, which I think they're negotiating right now. Some accord where they weaken the dollar a bit. Everyone comes down, markets go higher. I think that's the play. We just have to get through this period. If you don't have a Bybit or Apex account yet, links below to a $30,000 deposit bonus on Bybit and a 10% permanent fee discount on Apex. Just trade directly from your wallet on Apex. No centralized exchanges involved. Links below for everything. I'm James, this is Money GG. Cheers for watching, and I'll see you in the next one.